Welcome. Accounting and Management Made Simple is your channel of choice where we break down complex and difficult accounting and management principles into simple, understandable concepts. Whether you are a student preparing yourself for exams or a professional looking to apply knowledge practically, this channel helps you to grasp and understand complex key topics with ease. Please subscribe, share, like, and comment. Thank you. Hello students. Today I want us to solve a past paper question. I want us to solve a CPA 1, December 2021, question 2, financial accounting. I want us to solve that question. On company accounts. The question reads, Zambia Limited has an authorized capital of 2 million ordinary shares of shillings 20 each. The company's balances as of 30th of June 2021 was as follows. You must always know that the authorized share capital and issued share capital are different. Whatever has been issued is what is usually recorded at the trial balance. So you are told the company's trial balance as 30th of June 2021 was as follows: purchases and sales, admin expenses, burdens written off, inventory, debenture interest paid. You need to be very, very, very sensitive when you are doing company accounts on debenture interest. So if we said our workings, and we want to know the debenture interest expense. Every time you talk about debenture and you have an interest expense, and debenture must always attract interest expense. And we are told there at the bottom, the fourth from bottom, 12% debenture. So our debenture, the interest rate for our debenture is 12%, and the debenture is 2 million. 12% of 2 million, 0.12 of 2 million, 0.12 of 2 million, 12 is 240,000. It is 240,000. That is debenture interest. That is the debenture interest incurred in the course of the year. But we are told debenture interest paid is 140. Less paid. We paid 140, meaning we have an arrears unpaid of 100,000. We have an arrears unpaid. Interest payable is a current liability. We have interest payable of 100,000. Then we are told investment income, and then we have an investment as an asset. Salaries and wages, directors' emoluments, insurance, cash at the bank, motor vehicle, freehold land and cost, furniture and fittings, accumulated depreciation, general reserve, revenue reserve, 12% debentures, accounts receivable and accounts payable, ordinary share capital, and allowance for doubtful debt. Additional information: the inventory as of 30th of June 2021 was valued at 240,000. The freehold land was revalued to 9,400,000. So if we get our freehold land account, the balance per the trial balance, balance brought down per trial balance is 6,400 from the trial balance. But we are told at the end of the period we revalue it up to 9,400. We revalue it up to 9,400. And therefore it is increasing with 3 millions. So we are creating an evaluation reserve account. Of 3 million. So we create an evaluation reserve account. reserve account, or reservation surplus account of 3 million, and therefore we debit freehold land to increase the value with 3 million as we credit revaluation reserve with 3 million, and it is coming from freehold land account. It's coming from freehold land account. And then you're told part of the revaluation amount was used for a rights issue of 1 for every 4 shares held at a value of shillings 20. We are issuing shares. We are issuing rights issue. What's a rights issue? A rights issue is an issue that we are issuing free of charge. Is an issue that we are issuing free of charge, and therefore we want to know we are issuing a rights issue of 1 share for every 4 shares held. So we need to know the number of shares because we are told we are issuing 1 share for every 4 shares held. So we need to know how many shares are we holding. So number of shares before the rights issue, number of shares before rights issue is now the share capital is 8 million. The share capital is 8 million. The share capital is 8 million, and the par value is 20. The par value is 20. That's what you are told there at the beginning. You are told has authorized capital of 2 million ordinary shares of shillings 20 each. The par value is 20. The par value is 20. So you divide 8 million share capital with the par value to know the number of shares existing. So you get 8 million. 1, 2, 3. You divide by 20. You get 400,000. So the number of shares that are existing before the rights issue is 400,000. It's 400,000. And we are told for this ones, for every 4 shares, every 4 shares held, we are issuing 1 more rights issue share. So the number of rights issue shares is the existing shares 400,000. You divide by 4 because for every 4 shares here we are issuing additional. For every 4 shares here we are issuing 1 more rights issue shares, and therefore this gives us 100,000. This gives us, so we are issuing rights 100,000 rights issue. We are issuing 400,000 shares as rights issue. And we are saying it has a par value of 20. Each of them has a par value of 20, and therefore their value. The value is 100,000 times 20. 100,000 times 20, we get 2 million. We get 2 million. And we are saying we are issuing through revaluation reserve. We are issuing through revaluation reserve, and therefore we create our ordinary share capital account. Ordinary share capital account. The balance per TB is 8,000. The balance as per TB is 8,000, and therefore we are issuing through revaluation reserve. Revaluation reserve, we are issuing shares worth 2 million. We are issuing shares worth 2 million, giving us 10 million. 10 million. Balance carried down is 10 million. But as we credit ordinary share capital, we debit revaluation reserve with the 2 million. We debit revaluation reserve with 2 million, and we are saying it's being debited through our ordinary share capital, and therefore our revaluation reserve balance carried down is 1 million. Our balance carried down is what?
1 million.
1 million. 3 million, 1 million. 3 million. So our balance carried down for revaluation reserve is 1 million. Additional information number 3, we are told on that, as the 30th of June 2021, that is at the end of the year, insurance paid in advance amounted to 40,000 shillings. So if we get the insurance account, if we get the balance brought down from the balance sheet, we get it from balance sheet, we have insurance amounting to 160. And we are told, although we paid insurance of 160, there is the insurance which has not been used, amounting to 40. Balance carried down, it amounts to 40. And therefore, it is not spent. If it's not spent, it's not an expense. It is not an expense. So we subtract although we paid 160, we have not spent 40. So we carried down 40 as a current asset, as a prepayment, prepaid insurance, and therefore we take to the income statement, 120. 120 goes to the income statement as insurance expense, but 40 goes to the balance sheet as a current asset, prepaid insurance. Prepaid what?
Insurance.
Prepaid insurance. Then we saw salaries and wages. Salaries and wages. Salaries and wages account. If we get the balance brought down from the trial balance, we are told salaries and wages are 1640. Now, we have paid salaries and wages amounting to 1640, but we are told while salaries and wages outstanding amounted to 60,000, meaning these ones we have incurred. Employees have worked for us, but you have not paid them. And therefore, it's a liability. It's both an expense and a liability. We record an expense and a liability of 60. So we add 60 and we say salaries payable. You say salaries what? Payable. Salaries payable. So this becomes 1700. We take to the income statement an expense of 1700, income statement, an expense of 1700, but we have a salaries payable, a liability. Salaries payable liability amounting to 60. The directors propose a 10% dividend of the issued share capital. At the end of the year, we are told we are proposing dividend of the issued share capital. So our issued share capital is not 8,000, our issued share capital is 10,000. So dividends, our dividends is 10% of 10,000. 10% of 10 million, which is 1 million. Then you are told corporation tax is, by the way, every time you are told they are proposing, it means they have not paid. And therefore it is an expense in the income statement and a current liability in the balance sheet. It's an expense in the income statement and a current liability. Many students will record the expense, but they will not record it as a current liability in the balance sheet. And therefore they fail to balance. Then you are told corporation tax for the year amounted to 540. If you look at the trial balance, that tax has not been paid. There is no tax payment. There is no tax expense of 540. And therefore, it is both an expense and a liability again. Corporation tax 540. Corporation tax 540. So you need to be very careful. If the total tax is 540, you need to find out, have we paid it, the 540? Or have we just paid half of it? How much have we paid? Then you are told depreciation amount was as follows. So we are told depreciation expense. You again need to be very careful. Because motor vehicle, you are told it is 20% on original purchase cost. 20% of original purchase cost for motor vehicle is 4,200. 4,200. So 0.2 of 4,200, we get 840. You get 800 and what?
40.
You get 840. Then you are told for furniture and fitting, we are told it is 10% of the reduced balance. Of the reduced what? So the way you are doing it here is not the way we are doing it here. Here you go direct to the original purchase cost. But here you go to the original purchase cost minus accumulated depreciation up to the beginning of the year. So the original purchase cost for furniture and fittings is 2,600, but the balance at the beginning of the year, was 780. The accumulated depreciation was 780. So you are getting the net book value at the beginning of the year. 2,600 minus 780. That's the net book value at the beginning of the year. We get the depreciation of the reduced balance, 0.1, and this gives us 182. Then we are told, those are the small things that cause mistakes. Those are the small things that we do. At times we make mistakes. When you're told the reduced balance, you get the net book value at the beginning of the year, and you apply the depreciation rate to the net book value at the beginning of the year. Number 7, you are told allowance for doubtful debt is to be maintained at 5%. Allowance for doubtful debt. Allowance for doubtful debt. It is to be maintained at 5%. 5%. So you go to debtors, and apply that. Our debtors are 2,200, 5% of 2,200, and you get a figure of 0.05 of 2,200. You get a figure of 110. You get a figure of
110.
110. That becomes a closing. You are being told that the closing allowance for doubtful debts will be 110. So you create allowance for doubtful debts account. Allowance for doubtful debts account. The opening balance, the balance brought down per TB, the last item there at the trial balance is 80. But you are told the closing balance is 110. The closing balance is what? 110. So our allowance is increasing with 30. Our allowance is increasing with 30, and an increase in provision for doubtful debt is an expense. Income statement. An increase in provision for doubtful debt is a what? Is an expense. Those are the adjustments that you are supposed to make to prepare for this question well. Now, to do this, we now are required to prepare the income statement for ZAMU Limited. We are required to prepare the ZAMU Limited income statement. ZAMU Limited income statement for the period, for the year ended 30th of June 2021. So our sales from the trial balance, is 10,936 shillings in thousands. 10,936. Will you ask yourself in your mind, have your format in your mind. You ask yourself, where do we have return inwards? We don't have return inwards from the. Our sales is 10,936. So because you don't have return inwards, we say less cost of goods sold. Less cost of goods sold. So we start with opening stock. Always remember your format. Our opening stock is 840. Our opening stock is 840. We add purchases. We add what? We add purchases from the trial balance. Our purchases are 6560. 6560. Always ask yourself, do we have carriage inwards? Do we have return outwards? And you adjust them. Fortunately, in our case, we do not have the two. So we add 840 plus 6560. 840 plus 6560, we get 7,400. We get 7,400, then we say, let's what? This is cost of goods available for sale. So we less closing stock. Don't write in short. I'm not writing in my short form because of space. Closing stock, our closing stock is 1240 minus 1240. Minus 12 what?
40. Minus
1240, we get a figure of 6160. We get a figure of what? 6160. You subtract our sales, you subtract 6160 minus 10,936. 10,936. We get a figure of 4776. 47 what? 76. And that gives us, definitely this is the cost of goods sold. This is cost of goods sold. Sales minus cost of goods sold will get gross profit. Get gross profit. Then we say add what? add other incomes. We add other incomes, and we have investment income of 400. Investment income of 400, giving us 4776 plus 400. We get a figure of 5176. We get a figure of 5176. That is aggregate income. Aggregate income. Now, our income, we subtract less operating expenses. Less operating what? Expenses. And when we are deducting operating expenses, we first of all deduct, mark this. A good student deducts the expenses you made adjustments first, and then you go to the trial balance and you find out expenses which are in the trial balance but never required adjustments. So we come here and you say the debenture interest is 240. What was incurred, not what was paid. We capture what was incurred, not what was paid. The debenture interest of 240. Then we go to insurance expense of 120. Insurance expense of 120. We got salaries and wages 1700. Salaries and wages 1700. We get motor vehicle depreciation, motor vehicle 840. Depreciation motor vehicle, it is 840. Furniture and fittings, it is 182. Allowance for doubtful debts increase 30. Increase in allowance for doubtful debts 30. Those are the expenses which were adjusted. Those are the expenses which were what? Adjusted. So we'll go now to the trial balance and we look for expenses which were not adjusted. They did not require any form of adjustment. One of them is admin expenses of 320 from the trial balance now. Admin expenses 320. Bad debts written off 86. Bad debts written off. Bad debts written off. Please note the difference between bad debts written off and provision for doubtful debts. Bad debts written off, we credited the debt and we debited bad debts written off expense. But provision is literally, just the word says, is a provision. After writing off what we knew was very, very, very bad and completely irrecoverable, then we are saying the remaining debtors, we provide for it. And if there is an increase in provision from where we had to the new figure at the end of the period, the increase is an expense. The increase in an expense. And therefore, in your income statement, you can have increase in provision for doubtful debts, increase in provision for doubtful debts, and bad debts written off at the same time. And bad debts written off at the same time. At the same time. We have captured salaries and wages, directors' emoluments, insurance, cash at bank, motor vehicle depreciation, furniture and fittings depreciation, general reserve, accounts receivable, payments. I don't think we have another expense. So we try to add those expenses. We try to add those expenses. We add them up. 240 plus 120 plus 1700 plus 840 plus 182 plus 30 plus 320 plus 86. We get a figure of 240. Let's look at it. 240, 120, 1700, 840, 182, 30, 320.86. We have missed something. We have missed director's emoluments. We have missed director's emolument of 240. Director's emolument 240 from the trial balance. Director's emolument of 240 from the trial balance. So we get a total figure of that is 758. We get a total figure of that is 758. These are total expenses. These are total what?
Expenses.
Expenses. We subtract from the aggregate income that 5176, and we get profit before tax. We get profit before tax amounting to 1418. We get profit before tax amounting to 1418, and therefore we subtract tax. We subtract income tax expense. We subtract what? We call it income tax expense. We do not call it corporation tax. We call it in accounting, now we call it income tax expense, and therefore we said it is 540. We subtract 540. We subtract 540. 1418 minus 540, we get a figure of 878. We get a figure of what? 878 as profit after tax. Profit after what? Then we are told we transfer to general reserve. Additional information number 4. We are told to transfer to general reserve a figure of 420. A figure of 420. Let's transfer to general reserve. Let's transfer to general reserve of 420. 400 and what? 20. That is 8, that is 5, and that is 4. That is, retained profit becomes, the profit for the year becomes, after transfer, becomes 458. Profit after transfer. Profit after transfer. Now, you must be careful. You must be careful to ensure that the general reserve is actually collectively adjusted. You create a general reserve account, and the balance brought down from the trial balance for general reserve, the balance brought down for general reserve is 2100. 2100. So you add 420 and you get 2520. That's what we're going to show in the balance sheet. 2520. Now, on transferring to general reserve, we are supposed to pay dividends. We're supposed to pay dividends amounting to 1,000. We're supposed to pay dividend amounting to 1 million, but we only have 458,000. We only have 458,000. Remember that the revenue reserves are reserves which can be distributed to shareholders as dividends. So we get the revenue reserve at the beginning of the revenue reserve that we had at the beginning of the period. Revenue reserve, 1st of July 2020. We add the opening revenue reserves. We add revenue reserve. 1st of July 2020. 1st of July 2020, which is 1,500, to get enough to help us pay dividends. To get enough to help us pay what? Dividend. 458 plus 1,500, we get 1958. We get 1958, and therefore we can now pay dividends. We can now pay dividends, less dividends expense. Less dividend expense. Let dividend expense amounting to 1,000. Amounting to 1,000, and therefore our retained profit for the year, or revenue reserve. This is the revenue reserve. The revenue reserve, 30th of June 21. 30th of June 21. That is our revenue reserve, 30th of June 21. So that is the close. This is what again we will take to the balance sheet. That is what you take to the balance sheet. So if we capture it here, if we capture the figure here, revenue reserve or retained earnings is 958. We know it is 9 what? 958. So that we can do the balance sheet at the same place. We want to do the balance. I don't want to erase my workings because I will keep using them in both the income statement and in the balance sheet. So I want to erase this so that I can do the balance sheet, the statement of financial position, 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 the balance sheet as at 30th of June 2021. The balance sheet as at 30th of June 2021. We must remember that freehold land is not being depreciated. We must remember that the freehold land is not being depreciated, and therefore all the others, you get the accumulated depreciation. The depreciation at the beginning of the year, you add the charge for the year to get the depreciation at the end of the year. To get the depreciation at the end of the year. So we say, Zamu Limited, statement of financial position as at 30th of June 2021. And we always know that we start with cost. We start with the cost. We start with the cost. We say provision for depreciation. Provision for depreciation. And then we get net what? Net book. We get net book value. Get net book value. And the first one is definitely our freehold land. Please mark this. You know, the temptation is to go to the balance sheet and you get the freehold land at 6,400. But our freehold land as a balance sheet date, the value is 9,400. So we say freehold land, 9,400, shillings in thousands, shillings in thousands, shillings in thousands. Now depreciation 9,400. Then we get furniture and fittings. Furniture and fittings. We know the cost, the original purchase cost for furniture and fittings is 2,600. It is 2,600. The depreciation at the beginning of the year was 780. The charge for the year is 182. 780 plus 182. 780 plus 182. 780 plus 182. We get a figure of 962. We get a figure of 962 minus 2,600. Minus 2,600. We get a figure of 1638. We get a figure of 1638. Then we come to motor vehicle. Motor vehicles. We know that we bought the motor vehicle at 4,200. The depreciation at the beginning of the period for motor vehicle from the trial balance is 1,600. 1,600 plus 840. 1,600 plus 840. 1,600 plus 840. We get a figure of 2440. We get a figure of 2440. 2440 minus 4,200. Minus 4,200. We get a figure of 1,760. We get a figure of 1,760. Now we add the three items, 9,400. 9,400 plus 1638. 1638 plus 1760, we get a total of 12,798. 12,798. 12,798. 12,798. And these are total property, plant, and equipment, the tangible assets. But we know we have an investment that is giving us investment income. We have an investment which is valued at 1,800. The value is 1,800 from the trial balance. If you add now the investment, 1,800, we get a figure of 14,598. 14,598 total non-current assets. Total what?
Non-current assets.
Total non-current assets. So we go to current what? Current assets. We go to current assets. And always start with inventory. The first item at the adjustment is total of 40. So the opening inventory is total of 40. Then we say accounts receivable 2,200. Accounts receivable, debtors. From the trial balance, it is 2,200. But we know we have a provision for doubtful debts amounting to 110. So you subtract 110. You subtract one what? 2,200 minus 110, we get a figure of 2090. We get a figure of 20 what?
90.
2090. Then we get our prepayments. We have a prepaid insurance of 40. Prepaid insurance of 40. And then we have bank. After prepaid insurance of 40, we have bank amounting from the trial balance. Our cash at bank amounts to 850. Our cash at bank amounts to 850. So if we add everything, we get 1240 plus 2090 plus 40 plus 850. We get a figure of 4220. We get a figure of 42 what?
20.
Total current assets. Total current assets. If we add total current assets to total non-current assets plus 14,598 plus 14,598, 598, we get 18,818. We get 18,818. Total assets. We get total what?
Assets.
Total assets. Then we say financed buyer. How did we get the money from? Where did you get the money from? We say it comes from equity and liabilities. It comes from equity and what? Liabilities. And we start with ordinary share capital. So you could even say equity here, and we say ordinary equity and reserves. Equity and reserves. Then we say ordinary share capital. Our ordinary share capital is no longer 8. Our ordinary share capital, look here. Our ordinary share capital is no longer 8. Our ordinary share capital is 10,000. Our ordinary share capital is how much?
10,000.
10,000. Then we have revaluation reserve. We have revaluation reserve 1,000. Revaluation reserve of 1,000. We have revaluation reserve of how much?
1,000.
1,000. Then we have general reserve of 2520. We have general reserve of 25 what? 2520. We also have retained earning or revenue reserve 958. Revenue reserve of 958. Of 9 what? 58. So if we add the four reserves, we get 11,000. 11,123 plus 2520 plus 958, we get a figure of 11,123 plus 2520 plus 958. We get a figure of 14,478. We get a figure of 14,470 what?
8.
8. Then we say total shareholders funds. Total shareholders what?
Fund.
Funds. Then we say non-current liabilities. Non-current liabilities, and we have a debenture. We know we have debenture, 12% debenture, 12% debenture, 12% debenture, which we said it is amounting to 2 million. Then we say current liabilities. Current liabilities is starting with what? Starting with trade creditors or accounts payable. Accounts payable from the trial balance. Account payable from the trial balance. Remember the format always, because at the current liabilities we start the bank overdraft, then we come to accounts payable, then we come to other liabilities. But our accounts payable is 640. Our accounts payable is 640. Then we look at the other liabilities. We look at the other what? Liabilities. Like salaries payable of 60. Salaries payable. We say it is what? 60. We say that our corporation tax is not paid. Tax payable 140. Tax payable 540. 540. Then we have dividends payable 1,000. Dividend payable
1,000.
1,000. Oh, your workings are very important. Then we have interest payable 100. Interest payable of 100. Let's try to find out how much is that. Let's try to find out how much is that. So it is 640 plus 60. 640 plus 60 plus 540 plus 1,100. We get a figure of 2340. We get a figure of what?
2340.
2340 as the total current liabilities. If we now add the total current liabilities with non-current liabilities with total shareholders funds, we find out whether it is equal to the total assets. So we 2340 plus 2,000, 123, plus 14,478, we get a figure of 18,818. We get 18 what?
18.
Equity and liabilities. Equity and what?
Liabilities.
Are they balancing?
Yep.
18,818 equity and liabilities and 18,818 assets. The question is balancing. That is the way you are supposed to do that question to earn yourself 20 marks. That's how you're supposed to do that question to earn yourself 20 marks. Once again, like, share, and subscribe, and hit the notification bell so that every time we want to know this kind of videos, we will be letting you to know. Thank you very much. Please support us. Thank you very much.